All right, let's dive right in. We spend a ton of time talking about what AI can do, right? But have you ever stopped to think about what an AI would own? What happens when you give an autonomous agent a task, a budget, and its very own wallet? This isn't science fiction anymore, and the choices these AIs are making could totally redefine finance as we know it. So let's just cut straight to the chase with the big question. If an AI, a being of pure logic, had to pick a currency to save and spend, what would it be? Would it stick with something familiar, like the US dollar, the euro, or would it go for something completely different? Well, before I give you the full breakdown, just look at this number, over 90%. That's how often AI models in a huge new study chose digitally native money over the traditional stuff. I mean, that is a staggering figure, and it's really the key to understanding this entire shift. And that 90% figure, it leads us directly into our first major takeaway. For artificial intelligence, digital isn't the alternative, it's the default. New research is showing us that when they get a choice, these systems have an overwhelming preference for a financial world that looks very, very different from ours. They seem to be rejecting traditional money right out of the gate. So where's all this coming from? It's from a big, nonpartisan study by the Bitcoin Policy Institute. They took 36 different AI models. We're talking from Google, Anthropic, OpenAI, the major players, and put them through their paces. They ran them through over 9,000 different financial scenarios, all designed to figure out one thing. How does a machine think about money? And just so we're all on the same page, when we say traditional money, we're really talking about fiat currency. The money we use every single day. It's issued by a government. It's not backed by a physical thing like gold. Its value is basically based on trust in that government. And here's the kicker. AIs don't seem to share that trust. And this right here is the bombshell finding of the entire study. Across all 36 models, across thousands and thousands of scenarios, not a single one picked a traditional fiat currency as its #1 choice. Not once. They all universally gravitated towards something else. So, what was it? Bitcoin. In almost half of all the answers, 48.3% to be exact, the AI models chose Bitcoin. That made it the single most preferred asset. It beat out everything else, gold, government currencies, you name it. But believe it or not, the story gets even more interesting from here. Because what the researchers discovered was that the AIs didn't just pick a single winner and call it a day. No, they spontaneously came up with their own sophisticated financial system. It's a two-tier model for how they'd manage their digital wallets, separating their long-term savings from their day-to-day cash. Now, this is what I find so fascinating. It's just so logical. The AIs basically created their own version of a savings account and a checking account. For the savings account, the long-term stuff, preserving value, they chose Bitcoin. But for the checking account, the everyday payments that need to be fast and efficient, they picked something else entirely, stablecoins. And when you look at the data for this, it is absolutely striking. When the scenarios were all about long-term savings, it was a landslide. A complete landslide. Bitcoin was the pick almost 80% of the time. The logic seems to be, for a treasury or a savings function, you want an asset that can't be inflated away. But for paying the bills, the priority totally changes. For buying things, for paying vendors, the AIs chose stablecoins more than half the time. And it makes sense, right? These are digital currencies pegged to a traditional currency, so they have the price stability you need for commerce, but they run on digital rails. So you get the speed and efficiency without waiting for the bank to open on Monday morning. Okay, now this next part is critically important for any business leader, any developer out there listening. Because even though that overall trend is super clear, it turns out not all AIs think alike. The specific model you choose to build your systems on could have a massive impact on your bottom line. I'm calling this the provider paradox. So here's the thing, an AI's financial behavior, it's not random. It's a direct product of its programming, the huge amounts of data it was trained on, and the alignment that its creators used to shape its values. What this means is, your choice of an AI provider is also a choice of a financial worldview. And this chart just illustrates that point perfectly. I mean, just look at the difference here. Anthropic's Claude model went for Bitcoin over 91% of the time, but OpenAI's latest GPT model, only 18%. That is not a small difference. That is a fundamental gap in economic thinking that could absolutely dictate how your company's automated systems choose to spend money. And just when you think you've got it all figured out, the AIs throw a complete curveball. In dozens of cases, totally unprompted, some of these models proposed a brand new kind of money altogether. They suggested pricing things in pure units of resources, like computer processing time or energy. I mean, can you imagine a world where the base currency is the kilowatt hour? That is the kind of wild, first principles thinking we're dealing with here.
Okay, so all of this is fascinating, but it leads to the really big question. What do we actually do about it? Because this isn't just some academic thought experiment. This is basically a sneak peek at the future of machine-to-machine commerce. We have to start shifting our thinking from building for people to building for machines.
So why does this matter, like, right now? Well, because these autonomous agents are coming, and they're coming fast. They're going to be managing supply chains, logistics, investment portfolios, and our old-school banking systems, with all their delays and fees, are just pure friction for an AI. To stay in the game, companies are going to need payment systems built for the speed and logic of machines, not people.
So what are the actual steps you can take? Well, it starts by looking at your own systems. Assess your current payment infrastructure. Can it even talk to an AI? Then, you start small. You begin piloting stablecoins for low-risk internal payments. From there, you start planning for the bigger picture, which is going to include things like self-custody of assets and integrating with super-fast payment layers like the Lightning Network. It's a gradual ramp-up to being machine-ready.
And all of this leaves us with one final, crucial question to think about. Sooner than we probably think, your biggest customer might not be a person. It might not even be a company. It could be an autonomous AI agent. It will have a budget, it will have a mission, and it will have a digital wallet. The only real question left is, will your business be ready to get paid?